Module 3, Gross Income and Basic Individual Deductions. In the world of taxation, the concept of gross income is foundational. It's the starting point from which income tax is calculated. This module will explore the nuances of gross income, the types of income it includes, and the exclusions and deductions that modify it to arrive at taxable income. The nature of gross income. Gross income, as defined by the Internal Revenue Code, encompasses all income an individual receives in the form of money, goods, property, and services that are not tax-exempt. However, gross income is not just a summation of one's earnings. It reflects a variety of income sources, each with its own tax implications. The first distinction in sources of gross income is between income derived from services and income from property. Income from services typically includes wages, salaries, and professional fees. Essentially, it's what one earns from working. In contrast, income from property includes earnings like rent, dividends, interest, and royalties. These earnings result not from labor, but from investments or ownership of assets. However, not all income is taxable. The IRS specifies certain types of income that are exempt from gross income. For instance, gifts and inheritances, certain types of life insurance proceeds, and interest from state and local bonds are generally not taxable. These exclusions are critical in determining what constitutes gross income. Taxable income. Taxable income is a critical concept in understanding one's tax obligations. It is generally defined as adjusted gross income, or AGI, reduced by either the standard deduction or itemized deductions, whichever is greater. AGI itself is calculated by subtracting certain deductions from gross income. These deductions include expenses like student loan interest, retirement contributions, and alimony payments. While many types of income are included in gross income, there are notable exceptions. Items like pension benefits, rent income, and interest earned on a bank account are taxable and thus included in gross income. However, child support payments received are a notable exclusion from gross income. When computing AGI, certain deductions are allowed. These include contributions to health savings accounts, trade or business expenses, and rent and royalty expenses. However, state and local income taxes are not deducted from AGI but can be itemized deductions. Case study, Caesarini v. United States. To better understand these concepts, consider the landmark case of Caesarini v. United States. In this case, Mr. and Mrs. Caesarini bought a used piano for $15. Some years later, they found $4,467 in cash hidden in the piano. They declared this find as gross income in their tax return, later filing a claim for refund, asserting that the found money was not taxable income. The IRS and the courts disagreed. The money was deemed taxable under the broad definition of gross income. This case exemplifies the IRS's extensive interpretation of what constitutes income. Anything that can be valued in monetary terms, not specifically excluded by law, is likely to be considered part of gross income. Income tax deductions. Let's now turn to income tax deductions. In the context of U.S. income tax, understanding deductions is vital for taxpayers to accurately compute their taxable income. Tax deductions are expenses allowed by the tax code to be subtracted from a taxpayer's gross income, reducing the overall taxable income and, by extension, the tax liability. Tax deductions are categorized into two main types: deductions for AGI and deductions from AGI. Deductions for AGI. These are deductions subtracted directly from gross income to arrive at the adjusted gross income. They are beneficial as they lower the AGI, which can affect eligibility for various tax credits and deductions. Examples include contributions to retirement accounts, health savings accounts, and certain business expenses. After calculating the AGI, taxpayers can subtract either the standard deduction or itemized deductions to determine their taxable income. Itemized deductions include expenses such as mortgage interest, state and local taxes, and charitable contributions. The standard deduction is a crucial aspect of income tax calculations. It's a flat amount that taxpayers can subtract from their AGI, and it varies based on filing status, age, and other factors. The standard deduction simplifies the tax filing process for many individuals by eliminating the need to itemize deductions, especially if their itemizable deductions do not exceed the standard deduction amount. For example, a lawful permanent resident or their spouse typically qualifies for the regular standard deduction. Compensation and taxation. Compensation for work comes in various forms, including wages, salaries, and bonuses. Wages are often paid based on the hours worked, whereas salaries are usually fixed and paid at regular intervals irrespective of the exact hours worked. Bonuses are additional compensation and are typically awarded based on meeting certain performance criteria. The taxation of bonuses can be complex, especially regarding their timing and inclusion in taxable income. Dependents and tax credits. Claiming dependents on a tax return can significantly impact a taxpayer's deductions and credits. In general, taxpayers can claim dependents if they provide substantial support to them, and the dependents meet certain criteria related to age, relationship, residency, and income. For example, in a scenario where a couple supports their adult children, one of whom is blind and not a full-time student with no income, and the other is a full-time student with a small income, the couple may be able to claim both as dependents under specific conditions set forth by the IRS. Earned Income Tax Credit. The Earned Income Tax Credit is a significant refundable tax credit targeted at low to moderate income working individuals and families, particularly those with children. The amount of Earned Income Tax Credit benefit depends on the taxpayer's income and the number of children they have. Being a refundable credit, the Earned Income Tax Credit can reduce the tax liability to below zero, resulting in a tax refund to the taxpayer. In the next module, we'll look at income tax computations.